What if I told you there's a hidden world of investors who can fund your dreams, but nobody teaches you how to access them? See, in the next few minutes, I'm going to reveal the exact playbook that turns emerging managers into multi-million-dollar fund leaders that secret institutions do not want you to know. All this and more coming right now. Here we go. Welcome to the show, man.
Ryan, I'm really happy to be here. It's good to finally see you in person, and you have a real radio voice. I got to tell you, I love hearing you talk.
Yeah, I got a face for radio too, man. So this is exciting, and we, thank you for that. You're awesome, and I've really enjoyed our time getting to know each other. And we've been very fortunate to be in the top, 2 or 3% in the world. I think we're number 2 or 3 in the world for private equity shows. So awesome. We rank on a few, but that's awesome. It's all because of amazing guests like you. So let's jump right into it, man. So when you're raising capital from family offices, you've done well. I mean, you built a firm. You've done a lot in business. You built it up to 500 million AUM, and now really raising capital. As I always say, without capital, it's just a bunch of smart people having coffee over Zoom. It's like, what are we doing here? Someone's got to put money into the deal. So whether you're a fund, a syndicator, an entrepreneur, at the end of the day, nothing happens unless we get some money in the deal. So how do you win when raising capital from family offices?
Yeah, great question. Family offices are luckily an asset category that's really grown up over the last decade or so, and have become more sophisticated. And I think especially for emerging managers, it's a great category after. So your question of how do you win with them, I think you got to make a real focus on it. I think family offices and going to them is a different strategy. They operate differently than institutions. They diligence differently than institutions. They make investment decisions differently. And ultimately, they interact with you differently. So for us, when we started this, it wasn't intentional. We actually initially looked at raising traditional investment funds, traditional institutions. We sort of stumbled onto family offices and it just felt right and went from there. And I think it's been a really good model for us. But again, I think the overall secret, and I'll talk more about it, is you just got to make a decision that you really want to go out to family offices and build your strategy around it. And I think that one reason why all of our funds have come from family offices and no from institutions is just that. I think if we tried to do both approaches, it would have been really hard.
So what would you say is the difference? Just a quick high level overview for people who are trying to raise capital and just figuring out, do I raise it from everybody? Do I do institutions or family offices? What's your position on the difference between raising from an institution versus family office?
Yeah, so institutions, just to clarify for everybody, I think probably people know what they are, but in my world, the way I think about them, they're endowments. They could be operating on behalf of hospitals or universities or anything along those lines. They're run by agents, which means these are people who every year get judged on their performance and get a bonus at the end of the year. They're always looking for new opportunities. They tend to have good access to deal flow. Institutions are by far the most popular people to raise from for a lot of different reasons. That's historically where the most capital has been, but institutions are long-lived. So if you get an institution on board your first fund, you're probably going to have them through all your funds going forward if you do a good job. Family offices are a little bit challenging on that. I'll come back to that. Family offices take a whole lot of different forms. And so I got to kind of talk through those. Some of them look like institutions, or they might look like an outsourced CIO model where a wealthy family or series of families have hired a staff of agents to kind of manage their money for them. Now you can also look at it, and within that, there's even subtleties to that. Sometimes those things are the family's completely hands off. They're not involved in the investment decisions at all. They're letting them go and run. They might give them some themes to invest in. They might be interested in certain types of technology, certain types of markets, but they let them run free. There are others where they're the front end on doing the diligence, but in the end, family members make the decision or the family office makes the decision. So they operate differently that way. Then there are family offices that are run by the families themselves. And in a lot of cases, those will be the people who made the money. Some cases, it's second generation. In some cases, it's multiple family members from all branches of the family that are involved in it. And even then, the decision-making process can be very, very different. And we have all flavors. Our investor base comprises from small family offices that are in essence 1 or 2 people that are run by family members, all the way up to very large institutional-like family offices. In some ways, there are similarities in every single one of them. The families are a key part of it, regardless of how you go about it. But they are different, and it's important to know the differences when you're doing your research.
So knowing the differences. Now, I'm curious because, I have my experience and you have yours, and I think there's a lot of intersection on that. But one of those is, I use this analogy. So I've taught lots of people on my philosophy on raising capital. And I was doing this big event, and I asked, who here has laid paving stone? And everyone said, yeah, okay. A few hands raised up. And I said, what's the last thing that you do when you're done? And one guy says, go drink a whole case of beer and forget it ever happened. And I said, okay, I get where you're coming from. That's not what I mean. We're talking it was a funny joke, but I said, the last thing you do is you put on sand and you fill in the cracks, right? And for those landscapers out there, maybe I'm doing it wrong. So the metaphor of that is, well, what fills in the cracks? And often what I've found, and I'd love to hear your opinion on this, is what fills in the cracks of a solid pitch, especially to family offices, it's a good story. You ever had any experience with that, or is that right or wrong, or what are you seeing when you fill in the cracks? Because you have all the blocks, and here's our thesis, and we're going to do this and achieve wonderful things in your name, and whatever it is you're declaring to this family office. But then there's these subtle things that lock it all together that sometimes gets missed. And I'm curious if how does that fit into pitching family offices?
Yeah, great question. So first of all, you've been into institutions, and you know how they work, right? So you walk in, you have a very standard pitch deck for every single one of them. It starts off with your faces and all the great things that you've done, followed by your metrics and how great they are, and then a thesis, and then some pipeline information, all things like that. But the meetings are all very, very similar. And they come back and they'll typically tell you, here's what our portfolio allocation looks like right now to venture. It's either something we're underweighted to or overweighted to, and here's our process. They're very, very standard meetings. Family offices, they do care about performance. In the end, they're trying to really find a good manager to back. But in the end, they care about the relationship. And the thing that really seems to really get them interested in it are stories. They're business managers typically. They built businesses. They're involved in running businesses. They like to hear stories about businesses. And so one of the things I discovered early on, we were raising money, I used a standard pitch deck, right? Beautiful PowerPoint. I designed a lot of the graphics on it. Lots of numbers, lots of thesis. And then I had the companies at the very end. We had 3 companies that we were contributing into the fund. We had a pipeline. And when I got to that part and I started talking, I started noticing family offices got very engaged. And they would start asking about the customers. They'd say, okay, well, this company looks interesting. We might be able to do something like this in our business. Tell me more about this. And I found that because I'm an operator, ex-operator, I was way more engaged. And so we would start talking about the business. We'd talk about the founders. They would make connections to them. Oh, that sounds like a really interesting founder. Tell me about it. Is running a software company, is it good to come out of the sales organization? Do you want them out of the product organization? They ask questions like that. So tell me about this. How does channel work in it? So they love stories. And so I changed our pitch a lot. Now you have to tailor it in a lot of cases to what they're interested in. I'll get to that in a second. But in essence, I flipped it around. I would start my deck with, let me tell you about the companies we're working with. Oh, I think they're really interesting. And that would build into the thesis and I'd build into our results. And that was the way to go about it. And in the end, that's the way to get them really engaged and feel like you have a good relationship. And they felt like they were part of the story. I think that's really important.
Oh, I love that. And, okay, I'm glad that we have very similar intersections on that. From early on when I started to appreciate this lesson and kind of learn the differences between retail institutions, I always call family offices kind of that bridge between retail and institutions, depending on the size. But there's a couple of things that I've learned. Number one, I started to create what I call a story bank. And so just a weekly thing, I'll just look back on the crazy stuff from childhood or future or friends or whatever it is, and just keep that handwriting and create a story bank. I would say that was probably the number one thing that really helped me. And then the second one from family offices, and I'd love to get your opinion, is I always say, if someone asks my opinion, I say, you want to think when you're pitching a family office, you want to think in terms of conversation more than presentation. Even though it is a presentation. But if you come in, which I've done, and I made that mistake early in my career, where you come in and you present like you did in like your grad school, it's great. They're going to get a lot of sleep that night, probably in that meeting. If you present like that, you put them to sleep. But when you have those stories, it keeps it engaging. And so when you really get good at that, and you could keep a story bank, and then you say, I'm going to use this to, when I present my thesis and all that, you present it in a way where there's better flow, where it feels like more of a conversation than this wooden presentation. Have you found something similar as well? Where
I'll give you an example story they used all the time. So our model is set up on this concept of long-term investing, right? Our fund does not have an expiration date on it. We can hold things for a long period of time. And for family offices, that actually seems to resonate really well. But the story I would tell is about my previous experience with a company called Rackspace. We had great investors. We had Sequoia and Norwest involved with us. And we went public on August 8th, 2008. I bet you remember that year very well, Ryan. I do. You
know my story, yeah.
Yeah, I know your story. And it was the last IPO before the market cratered, before Bear Stearns happened. It was a mess. And we were growing 60%. We were profitable. We didn't need the money. And we were forced to go public because that was their model. We were in funds that were from the mid-90s. They were shutting down. They needed liquidity. Now, I always felt sorry because I remember our first trade was supposed to be at 18. It actually came in at 10. And within a short period of time, we were at 4. And we were basically $400 million market cap company with $600 million in revenue. And we were growing and profitable. It was crazy, right?
Yeah.
But what happens? Those distributions are made and all those investors sell. And you flash forward 2 years later, we were worth $10 billion. And I look at things like that and say, and I always create this story of, would you ever arbitrarily make an investment and say, I have to sell this under any conditions 10 years from today? Would you do that? And I go, no, I wouldn't do that. And then I tell that story. And why is that story important to what I was doing? I was raising a permanent fund, right? And so being able to tell that story helped connect to it. They could all relate to it. So you don't have to tell story. I talked about, stories out of my portfolio companies, but I always found stories out of my past, out of my network that would connect to them, that they would relate to. And they always found that really, showing that experience matters. But being able to personalize it for them and get them to chuckle at it, it's important.
There you go. I was engaged. I could picture myself there and watching the trade not be what you wanted or what they would want it. And what a wild ride and great story, because it really brings people into your world and it fills in the cracks, right? So you have spreadsheets and cap tables and all of these things and yeah, cool. Like do that, whatever your financial advisors tell you to do. But what we're saying is they want to get at an essence of saying, I'm not just buying balance sheets or cash flow or whatever it is they're looking at. Yes, they are. But I'm also buying into you. Are you someone that is aligned for us? And as an executive as well, you're saying, yeah, sometimes the people I bring on to create value in the companies and the relationships that I have, are they going to be a pain in my butt? Or are they going to be pretty awesome to work with? Are you going to create problems for every solution, or are you going to create solutions for every problem? I don't know. Right? I can't make a decision just off a spreadsheet. So I just want to underscore the value of what you're telling people, because I couldn't agree more, which is you got to fill in the cracks, because that space needs to be filled. And you do that with stories. Absolutely love that. So moving on with, what are some principles that you can teach and perhaps help emerging fund managers and deal makers to raise money from family offices? What would you say?
Yeah, so I think the first thing is they are all different, right? You could seriously take the same pitch deck and go to the UT and Harvard and CalPERS and do a minimal amount of research and be fine. It does not work that way with family offices. And so to me, you have to do a whole lot of research on them. And sometimes that's hard, sometimes it's easy. The way I say it is, first thing to figure out is, what is their thesis? What are they trying to do? A lot of family offices are there specifically to support charitable giving, right? And so that matters, right? Understand what those charities are. How do they think about stuff? Some of them are there to support regions. They might be really focused on really supporting the state of Texas and things in Texas, or they might be focused on low income areas of Texas. There's all kinds of different strategies around regional investing. They might be very interested in supporting things that are around their business. So if you made your money in construction, maybe you want to invest in construction tech or anything related to that, right? Where they feel like they can bring their expertise. So do the research, right? One of the best ways to do the research is to try to do an intro meeting with them without an agenda. And so I tried really hard in my initial meetings to actually not go in and pitch. I would go in and talk about what we're doing. So, one of the secrets to fundraising in my mind is you're not fundraising until you really are ready to ask for the check, right? So I reach out to them. I'd say, here's my background. Here's what we're looking at building. I'd love to come talk to you about it and see if it's interesting to you. And I would use that opportunity to really learn about what they did. So there's the family, and then there's the individuals. Everyone in the family, oftentimes, if you look at the Waltons, are a great example. They're involved in all kinds of different stuff, right? So you can't look at them generically. You need to understand each one of them and what they're really passionate about, what they care about. I often spend a lot of time learning about their kids and what they're trying to do, because what I found is oftentimes they're interested in tech because of their kids. So a question I would ask, if you have a kid that's 13 or 14, I go, I bet they're learning Python in school. And they go, they are learning Python. I think it's really exciting. They got to be careful, because that often would come with, would you hire them as an intern? To which I would say, I don't do a lot of Python work right now. We're doing a lot of Excel work, but if they want to do that, that's fine. But take the time to learn about that, right? Just about them. That's before you actually try to learn about how they operate, right? So then that comes to that question of, how do they operate? How do they go about making investment decisions? And again, as I said before, they're all very different, right? Sometimes it's an investment committee. Sometimes a single individual. Sometimes there's outside advisors they want to bring in to look at stuff. Sometimes they actually will hire people like Cambridge Associates to come in and do that kind of work. But one thing I find is they're very open about it. You ask them how they make decisions. They'll tell you that. They'll let you know the process of it. And what I've also found is they can be really quick. Institutions are slow. Family offices, if you tell a good story and they're interested in doing it, they'll jump into it right away. Another thing is talk to them about where they failed and succeeded. Understand what's worked with them and what's not. So take a really interested with them. Like, tell me when you've had good investments, when you've had bad investments. What did you learn from them? What can I learn from them? And part of it is also getting people in the mode of like, you're here to help me build my firm. This is my first fund. I'd never raised a fund before. So I was very direct with them about this. It's a new company for me. I haven't done it. I would love your feedback. What have you seen works well? What doesn't work well? What can we do here to make it work? And in essence, we built this firm around a lot of that feedback that we got out the door. So, do your research. look at the family, look at their mission, look at the individuals, get a first meeting with them, then understand the structure and the process and go from there. I was basic sales technique. Don't try to close in the first meeting. Don't try to close in the second meeting. Spend a lot of time learning, a lot of time asking questions and building that relationship and going from there. So, that's the basics on how I would approach them.
Awesome. So just a high level on do your research of the family members, do your research on current and former businesses that they've invested in. And I would say maybe the third theme on your brilliant advice is just learn how they're structured, right? So one example might be, do you make decisions by committee, or is it just one patriarch or matriarch of the family that just says thumbs up or thumbs down? Are we in or not? How do you guys make decisions? I love that. Maybe even charities that they invest in can give you a bit of a clue of things that they care about. And often that could be part of their legacy. And so this isn't necessarily to manipulate or do anything funny there. You're just, all investments rely on trust, and a big way to build trust is alignment. And so you're saying, oh, they actually do love tech, and I'm offering a tech investment or whatever that might be. Oh, they love, they invest in sustainable agriculture in their charity in third world. Hey, that's cool. This is an ag tech fund. And so you can really find these angles and really just show alignment. So I think we're talking a lot about the difference between pitching institution versus family office. And while alignment matters on all investment theses, I would say alignment in the spirit of the deal between kind of the shape of your soul of your fund and the shape of their soul as a family office. Do these things blend well together? Anything else you can add to that?
Yeah, let me give you a couple of stories from the fundraise process, right? So we had one fund that I spent a significant amount of time with. And frankly, they were forming their family office at the time and trying to figure out their kind of process for making decisions. But one of the first things they did for me is they had me meet with the heads of the charities they support. And they told me, I'm meeting with them because their intention is all the investment returns are going to go to the people in this room. And by the way, speaking of inspiration, when you're sitting there and you're hearing all these stories about what you're trying to support, that was for me personally, that was rewarding. But I understood, okay, these guys really care about this. And actually, by the way, there's important points to that. So I would go back and say, okay, from that perspective, we're a permanent fund. We might hold these things for a long time. How do you think about your cash flow requirements? They're like, oh, no. We're not worried about whether you give us just distributions in years 2, 3, 4, 5, 6, 7, 8. This can be long term. We just are making sure that everything out of this is being allocated into those. But it did give me a question, which my first concern was, hey, if you're using this for cash flow to fund these things on an annual basis, that might not be the right, we might not be the right fit. At another firm that I met with that very much that ended up being an investor as well, that said, hey, we actually want you to help us support businesses in our community that may be tech or tech-enabled services that might not fit your thesis. Would you agree to sit and help us look at those as well? They may or may not be things we want to invest in, but we'd like to get your support on that, right? And by the way, family offices take more work. We should dig into that too. But it made clear, like, part of the relationship was they expected me to give them some of the knowledge back. And then I had another one that was very direct about, we want you to look at opportunities in this region. All you have to say to us is that you will spend your time sourcing in this region as well. And in those opportunities, if there's an opportunity for us to put more to work, we'd love to do it. So these are all different, right? They're different than what you're going to get from most institutions who don't have those requirements. And you got to dig into them as you go. I could probably give stories like that on every single family office we worked with, but they all have reasons that they exist and they want you to support it.
Yeah. I love that. And, one thing that's surprising that I started to learn, and you completely confirmed it, is a lot of fund managers, they find out that most family offices, they don't have access to all the best deals. I thought they were just this cathedral of capital that you go and they got access to everything and they're making it work. And a lot of times they do. But maybe not to the degree that a lot of people think. And I think that's good news, especially for an emerging fund manager who has the background and you can recruit a team and they really put something very cool together. I think this is good news. What have you found as far as pitching deals to family offices and they have certain selection criteria that may or may not have the best deals? I mean, what are you finding when you show up as a guy with some deals or at least a thesis? How does that go when speaking to family offices? Yeah,
great question, right? So I think I didn't know this when we started raising family offices, right? My assumption was if you have billions of dollars, you can invest in whatever you want. Turns out that's not the case. And one of our initial investors said to me very early on, we don't get access to the quality deal flow as far as funds go. They just won't take our checks. They're already oversubscribed. They've got their institutions. A lot of them don't really want to work with family offices unless there's a connection to their industry. In their companies. So if you've been a CEO of one of their companies and it got sold, sure, they're going to let you invest in their fund. But if you're, a real estate tycoon and have nothing to do with tech, you're not going to get into a great West Coast fund, right? And so that was surprising to me. And what I learned really quickly was, especially in the world of VC, the way they get into it is they make bets on emerging managers. It's a real thing for them, right? And a lot of emerging managers would assume that the challenges with families are the same as with institutions. Institutions, some specialize in emerging managers, but most really don't spend a lot of time on them. But family offices do. And by the way, I think this is a big reason the relationship matters to them. A lot of emerging managers don't have a lot of performance history to look at. You got to get a real judge for them based upon how they act, what their other experiences are, where they're going to work. But they do bet a lot on emerging managers. And in fact, I think if you went now and looked at, what most emerging managers are raising from, it probably is from family offices. And so the one thing you notice in it is they do worry about the adverse selection problem of, hey, if this is a club that wants me, do I want to be in it? So that is something they spend a lot of time looking at, because they do get a lot of folks in there that have no business raising capital. And my answer to that is usually to them, but my guess is that, right? When you look at them and they're like, yeah, we feel like we're a pretty good judge of that, which may or may not be true. But they do get a whole lot in to look at. And for them, it's making sure that that's important. And so how do they deal with that? Oftentimes they deal with that by saying, hey, I want you to meet so-and-so, right? And this takes two flavors. One is, I don't know anything about tech. I like you, but I want you to meet my friend Bob or Sue or whoever it is, and I want to get their opinion, right? And it's pretty clear up front that that's what the case is. And then there are cases of saying, hey, I like what you're doing. I'm going to bring my syndicate together and see if we can get something here, because I want to work with you, but I want more people that are engaged with it, right? So I would say almost all the family offices that we talk to were very interested in emerging managers, and they want to bring other people into it and get involved in it because they want to help validate that you're a good team to invest with. And so I think that's the good news. And again, I raised this money, it's been 10 years now since we raised it. The number of family offices out there has, exploded from where we were back then. Which makes the challenge even harder. There's more family offices looking for deals. They can't get into the deals. There's actually less funds being raised right now. I think we know that a lot of funds are essentially not going to raise new funds. So they have access to stuff. Family offices also understand this is the time to get in. One of the things that is always frustrating, I'm not a portfolio, I am an investor. I guess I am a portfolio manager, but I don't talk in terms of like, I've got 20% in this and 30% in that. I don't think that way. I basically invest in one category. You talk to institutions, a lot of what they'll tell you right now is, we're overweighted to tech. We haven't had liquidity in tech. We've got no DPI coming back. We're not making tech investments right now. And you can tell them all day long of like what SaaS multiples are now 3 to 5 times, or not 10 to 15 times. There's great quality companies, and they're not interested in that story. Family offices totally get that. And they look at it and say, no, we know now is the time to get, and we know now is going to be a good vintage. And we're really interested in putting money to work. So, in this market, it's actually good to go talk to them about it. But like big institutions, the challenge they have is liquidity right now, and trying to work through that. But that's the big difference with them. I think there's a real opportunity with emerging managers in general. But for right now, it's a really good time to go and do it.
That is an encouraging note if I've ever heard one, man. So thank you for that. One thing that you and I have spoken before this interview, and it was interesting, and I think people would really like to hear this, is about how family offices typically operate in networks. That was a very interesting concept. Wonder if you can unpack that a little bit for me.
Yeah, it's interesting. When we talk to institutions, I didn't ever, and I talk to institutions today, I don't feel like you ever really get into talking to other institutions. In fact, to a certain extent, they're competitive with each other. It's not the same way with family offices. And again, I just brought up the example of how they use you for validation, but this is how they get deal flow. So if you sit down with a family office and go through what they have, you ask them, tell me about your deal flow, like especially direct investments. Where do they come from? It's always other family offices. And in fact, by the way, that becomes a whole other interesting story in terms of how you can also create a sourcing proprietary advantage if you have the right family offices involved, because they oftentimes do get access to good quality stuff, especially in their region. But in essence, they share deals with one another. So it's not just about validating things. They share deals with one another, and they build really strong relationships around that. In fact, I have at least 2 family offices that run, I guess you could call them, kind of investor conferences, where they bring together their network of family offices together to have a conference once a year and talk about the trends they're seeing and so forth. So they operate that way. And if you were to go through our investor base and look at it, there's a heat map. I could put one family office in the center of it, and that can radiate out to others. And I'd say we have probably 5 networks really within our base, where I could say these 5 family offices are responsible for 100% of our fundraise, directly or indirectly. And I didn't expect that. Usually it's regional. Usually it's the people they know within that region. Sometimes it's sector specific. So again, if you're a family that made a lot of money in construction, you probably have a lot of other people in that space, or in energy, or you name it. Sometimes it's random, but I don't think I have I do have obviously single family offices that invested, but they were all part of a network. And one of our larger family offices, I would say, probably accounted for indirectly for about half of our initial fundraise. So I think that's one of the nice parts about it too. I think when we were raising money, we actually didn't know what our final close was going to look like. Our final close was 330 million, but 4 months before we thought we were going to raise 100. And then all of a sudden these networks just came in. I just started really populating in, and I didn't expect that at all. So yeah, I think that's a really good piece on how to think about raising money. If you do it right and that you get them engaged, you're going to find they bring in. One other point I would say on this is, you oftentimes would say, hey, these guys can only write $1 million check. I'm trying to raise $300 million. Why would I talk to them? So all those $1 million people introduce me to $20 million people, right? Because oftentimes they're the grinders. They're the ones that are really out there trying to get access to good deals themselves. If they're small and they can only write smaller checks, it's harder for them, even in the family office network, to get good stuff. So they work really hard. And so, you want to tell people prioritize things by the check size they can write. But the way to think about it is the check size their network can write. So again, doing the diligence and understanding who the people are, beyond just that one family office else they might know is usually really useful.
Oh man, prioritize by the check size their network can write. That is pure genius. Right on, man. That is amazing. So we're talking about kind of the front end, the beginning of the experience. We're filling in the cracks and we're telling stories and we're pitching our thesis. And guess what? It actually works. So now we get a check and now you're managing someone else's money and their networks of money. Now often, and I'd love to get your take on this. Often when you get capital, different people like different cadence, right? Different communication cadence. What have you found as far as once you have the money, you're doing deals, you're writing the checks to, just like you said you would. How does that work for your own back office? What should people be prepared to if they are raising from family offices? How should they prepare after the money lands? How do you structure your business to make sure that relationship continues to be strong?
Yeah, let me just say one thing up front, because I'm going to sound negative for a second. These investors are the most fun to have. They're very engaging. They're fun to go to dinner with. They're fun to hear their stories about their business. Getting to know their families is a joy, right? All that. But it's a lot of work. And it's a lot more work than you can get with an institution. So the way to think about this is you get the first check. By the way, the leading up to the first check is typically pretty easy. I would say that I should rephrase that. It's different than institutions, but you don't find them digging through your data rooms the same way an institution would and going through everything. They're very focused on the people and the stories and more about what the opportunities are that you have in front of you. They don't necessarily have a whole lot of document feedback. You're not going to be going back and forth with lawyers all day long and trying to get things revised. That process can go pretty smoothly. But once you have them on board, the maintenance is a little bit higher. So one of the first things I would tell you is these offices are very focused on cash flow and when cash flow is going to be required and when it's going to be coming in. Because again, sometimes they're funding very specific things. It could be charities I brought up. It could be a family wedding. It could be anything, right? And so I get asked this question all the time and I have to answer it. What do you expect for your cash flows? And, our documents say 20% over 5 years, annually. And they're like, okay, but what is it really going to be? And I get these calls all the time. And so I spend a lot of time trying to help them kind of model through that. They also are really interested in what's going on with the company. So you sell them a story. They want to know how things are going. And so we provide a whole lot of updates on how our companies are doing. And again, I want to try to do that as much as I can on we do it on a regular basis cadence where we send out anywhere between monthly and quarterly updates on what's happening with the companies. But I get follow-on calls. Some that connected with them, some they want to learn about. I spend a lot of time talking to them about what's going on within the companies and the fund. The other thing to keep in mind is they themselves don't always have sophisticated back offices. I always tell this story. We have someone that's on the top 200 wealthiest people in the world. And he is the one who always calls to confirm wire instructions. I think at one point I said to him, I go, don't you have someone else that could do that? And he goes, not that I can trust. And I said, okay, got it. So they don't necessarily have sophisticated back offices. And so that can mean, dealing with documents, dealing with taxes, dealing with changes can sometimes be challenging. You got to kind of work through that. And they go through changes on their end. These are families. They'll go through divorces. They'll go through changing generations who are running things. They'll move things from one entity to another. If you have international families, that adds a whole nother level of complexity to think through. So there's all that kind of stuff to deal with as well. But the one thing I always tell people to remember is they did invest in you, right? So we have a great CFO. She sits right next door to me here now. She's awesome, and I love her when she talks to them. But they want to talk to me and they want to talk to my partners. And so, one thing I do on a regular basis, we try to do this 3 or 4 times a year. I go on the road and I go meet with them, and I don't have an agenda. I just, hey, let me take you out to dinner. I find oftentimes that they actually use it as an excuse to get together with their buddies. And so, I'll suggest, hey, you want to do an individual meeting? You want to grab lunch? They're like, hey, why don't we do a dinner? Do you want to invite so-and-so to come? I go, yeah, why don't we pull a group dinner together? They use it to get people together. I always ask them, can you bring some people that I don't know as well? But I do a lot of social interaction time with them. And I think it's really important because, again, they are backing you as a team. They bought your story. They bought what you're doing. They can't be pawned off to other people in the organization. So it does take more work in that respect. And, I think if you get to the point where you treat them like institutions, where you send them just to your CFO and you expect them, you're not going to have a good long-term relationship with them.
Wow. So that is real intel from the front lines, brother. I appreciate that. So
real time, I've gotten 2 texts on my computer from family offices sitting right. I had to shut it down so I didn't see it pop up.
Yeah. So there you go. You're constantly hit up. And that's a cool thing, man. It just shows, these people we would imagine they don't spend time with people they don't want to. And so the fact that they want to keep seeing you, odds are obviously you're managing part of their portfolio. There's a business relationship there. And that makes me curious of what have you seen or what have you done to create that alignment between your investors and you guys as general partners? How have you created that alignment, and does that even matter?
Yeah. So, let me talk. One thing I think is really important to understand about them on the connection to businesses is they really do want to help your businesses grow. And so we have a company. We had a company called Fixed Software. I can talk about them. We've exited it. We sold it to a company called Rockwell Automation. They basically built SaaS software for maintenance professionals at manufacturers, and that was their business. And early on, I presented it to our investor base. It was one of our first investments we contributed. And we have some folks in the energy sector and the oilfield services sector in particular. And they looked at it and said, well, a lot of what they do could support how we run our oilfield services operations. Could we look at that? And fast forward to when we exited the company, it was probably the biggest vertical that they had. And it came out of our base. And so I learned really early on that you should actually get them engaged in working with their portfolio companies because they want to help when they can. And by the way, this is a reason why you also want to raise from family offices that are not just in tech. You want to raise it from people who can be customers, right? And really kind of use your products. So that's one way I get alignment, right? Which is, how do I get them aligned in supporting the business? Now, what do they expect from me in return? So when I started raising it initially, everyone told me, GPs are expected to contribute 1% to 2% of the fund and go from there. And I've always thought, well, look, first of all, I'm going to be doing this full time. I actually want to put as much of my capital into it because I believe it or not, I believe in myself. I believe my own stories, right? So we are already kind of weighted towards it. But I learned really quickly that is an expectation. They really do want to see that you have skin in the game in a way that's different than institutions. And so if you look at our first fund, 10% of the funding came from us. A lot of that came through our initial 3 contributions. So we had 3 companies we funded ourselves, we contributed in, but there's a high level of expectation that you're going to be economically aligned with them, right? And for them, economic alignment means, we know you're going to make money on the override, but we want you to also see that you've put real skin in the game and your own personal equity into it because you really believe in it. And why is that, right? So, if someone brings you an opportunity, if it's so great, right? Because I pitch things as being great all the time. I'm sure you do too, Ryan. If it's so great, the first question they ask me is like, why are you backing up the truck? Now, of course, there's a sophisticated answer to that. I'm like, I can't back up the truck every single time. I don't have that. But they would say, look, if you're not really willing to write a meaningful check to this, is it really mean that's something you really believe in or not? And I do think that's unusual. That's the state for family offices. So, do I think you can get by with doing less than 10%? Absolutely. But I don't think you should expect it's going to be 1% to 2%. They do want to see that on an ongoing basis. And so, that's one thing to think about. The other thing I would tell you is in the fundraising process, they are going to push you really hard on, are you 100% committed to this? Don't have to worry about you being distracted on other activities. How should I think about what your next fundraising is going to look like? Is that going to distract you from the outcomes on this fund? So, will institutions ask those questions? They will. Absolutely. But family offices really care about it because they do realize they're betting on you and they're expecting it to come out well needed.
I love that. So the alignment really comes by putting capital and having some skin in the game. Perfect. I can see that for sure. And the other one was just encouraging them if they like it and they want to, as I like to say, if you want to geek out a little bit on this business or one of our portcos, by all means, roll up your sleeves, get your hands dirty a little bit. We'd love to have you in certain degrees, but be prepared for that and just make sure that you create a good experience in there. And so if they're helping you with certain portcos and you got some skin in the game, that's what I'm hearing of just making sure that you're aligned, not just in the beginning over a steak dinner, but throughout the entire relationship. There's a method to that. I love it.
Yeah. It's not a passive relationship, right? Institutions, I would say, are more passive, right? You're reporting to them, you're giving reports, they're judging you. it's both ways. You want something from them, help the portcos that you guys are backing, and the same thing, they want something from you, which is show a high level of commitment to what we're doing.
Brilliant. And it's one thing to raise capital. It's another thing to profit and work in the markets that we've been entrusted to work in. So I'm just curious from your perspective, from your vantage point, you see a lot. I know you deal a lot on the tech side. What are you seeing right now in the market today?
Yeah, so I'll talk about the fundraising market for a second, and this is not going to be a surprise to anybody. It's hard, right? The fundraising market right now, especially for VC, is challenging. And a lot of that, there's really two components to that. I think some of it is just, the market is uncertain right now in general. And the other there is that people aren't yet sure how to read what's going on with AI. So on the fundraising side of family offices in particular, liquidity remains a real challenge. I think that you go to conferences now in the VC world, which I don't love going to conferences, but I do go and listen to hear what's happening. And DPI is the new thing. Everyone's talking about DPI, and why is that? It's because things that you've invested in, private alternatives over the last 5 to 7 years, have not really paid anything back. And so family offices, like anyone else, have liquidity challenges. And part of it for them is like just having the capital invest. They want to do it, but it's just hard to know when they're going to be able to have the capital to go and invest in it. And then on the AI side of things, to a certain extent, the market has been pretty standard 20-year SaaS investing model for a long time, right? And so the question is, what's your flavor on SaaS investing, whether it be VC or PE? How do you think about that? AI is creating real both opportunity and concern, right? And so a lot of folks are looking at this and saying, don't know how to read this opportunity. Is AI going to basically eat this SaaS world? And, am I stupid to be investing in someone that's really looking at SaaS opportunities, right? And I've had a lot of conversations around that. Luckily, we have good examples within our portfolio of where SaaS companies have leveraged AI to really accelerate their capabilities. But that has created a lot of challenges. I spend a lot of time talking about what's going on with the market and how it's going to affect SaaS. And then the last thing I'd say is there are just a lot of funds out there right now trying to raise. And a lot of those are existing funds who are out there trying to raise their new rounds of capital that they haven't been able to do the last couple of years because the market hasn't really been there. New emerging managers that are trying to do it. There's just a lot out there. So there's a lot of noise, which makes it hard. Now, I do think that's changing rapidly. A lot of people are deciding not to raise. A lot of people are shutting down, but there's still a lot of noise in the market you kind of have to navigate through. So that's kind of the fundraising market. The SaaS market itself and investing in it is tricky. It's a really unusual market right now. So if I look at kind of how I think about, the number one thing I care about, which is really not valuations, it's growth, what's going on. Spending's not great right now, especially if you're doing enterprise or mid-market SaaS. Spending levels aren't great. People have been sitting on their hands for a bit. We used to talk about replacement cycles. This is in the hardware world, right? When you can't run the same hardware for 3 to 5 years without replacing it. I do think we're at the very tail end of an innovation cycle where people have sat on their hands the last 2 or 3 years and tried not to invest, but the innovation's too good now. And I do think we're starting to see it kick up again in companies wanting to invest because they've missed out on all of these latest tools that have come out. So I do think that's changing. Early market is showing that there's some growth coming back in, which is good. Cap tables, we really haven't had the capitulation trade on them yet, right? That's starting to happen. I think a lot of the data we've seen on exits have been occurring below a 1x for a lot of companies, but people are still trying to resist taking down rounds to a great extent, avoiding all that. We just need all that to wash out to make the market more investable. By the way, that has a negative effect on funds and a positive effect. They're getting DPI back, and then family offices and institutions want to see capital coming back, even if it's at a loss. But once you recognize that loss, it makes it hard to raise again, right? So I think there's good and bad things about it. But for investing, putting follow-on rounds into companies like we do, it's a little bit harder. We need more of the clear out of the cap tables to happen. And then there's just a lot of AI kind of whitewashing, copycatting going on right now. You pick your category. Agentic AI is one that I find both intriguing for consuming, but hard to invest in. So like, I'll give you an example. I'm looking at AI alternatives for SDRs, the guys that have to qualify leads as they come in the door. I can send you 50 companies that are building agentic AI to address that. Most of those are going to wash out, right? There's a whole lot of garbage out in the market right now. There's a whole lot of SaaS companies who say they're really leveraging AI on their product sets and aren't yet. That makes it a little bit of a challenge to work through right now as well. But in general, I feel like we're at the front end of what is going to be a good market. But that's where we are today.
Oh man, that is brilliant. And yeah, I'm very familiar, we'll say, with the SDR dialer. So we're testing our own as well. And you're right, there's a lot that just doesn't quite get it, but it does. At least we can take that as a signal to say, okay, maybe there's garbage, but at least there's investment going on in this area. Maybe we take a peek, or you don't. But either way, you're right. There's a lot of churn in the market, and we just got to see what settles, what blows away. How is this coming together? Now, from your opinion, this is what you're seeing, but where do you see the smart money going in the future? That's kind of my next question is, where do you see the next opportunities, just from your opinion?
Yeah. So, my entire thesis has been around workflow SaaS investing. And I don't want to take you through a history lesson of our fund, but I'll tell you how I got here. So when we started this thing in 2015, investing on our own before we raised in 2018, it really was focused on looking for what we call data-enabled SaaS companies, right? So if you go back 10 years ago, data science was still a relatively new concept. But the best SaaS companies were figuring out, the best SaaS workflow companies were understanding that we have a very valuable asset here. That asset is the data that comes out of our workflow. And we're the only ones that own it, right? Salesforce got this very early on, right? But a lot of the SaaS companies didn't. It took them a while to understand that, hey, no one else has this data. If a human or machine depends on us for this job, this data must be valuable. And the best companies were starting to figure out, okay, well, how do I start to transition my product from being a workflow product to an insight product? So how does it start to be something that someone doesn't come to orchestrate through their job, but to tell them where to spend their time in their job, right? And so that was our first thesis. And our first round of exits were really tied to that, which is companies that successfully made that transition, really were focused on trying to become insight products. That happened to translate really well into the world of AI. AI, in a lot of ways, it is just an evolution of data science and sat on top of it. And so my belief is there are thousands, tens of thousands of SaaS companies out there that are ripe for AI enablement. And when I say AI enablement, I mean on the front end, right? How do you, number one, use it to make your product better? How do you really use it to drive unique insights and help orchestrate a workflow? But on the operational side, how do you also use it to bend the arc of growth and grow faster at lower marginal costs? And, a lot of funds are spending time looking at kind of the back office side of things. And I am too, right? I'm spending time figuring out how you can use it for coding, how you can use it for customer support. But I am most intrigued, as I said, we talked about with SDRs. I'm most intrigued for how you can use this to actually go faster, right? I don't think we're that far away from a world where you can grow fast and not need to raise a lot of money. And so I think that's going to make VC a more interesting space. But right now, the SaaS market is really good because people are looking for those pure AI plays. They're looking at the seed stage in particular. For stuff that's further along, of course, they want to invest. But SaaS is, to a great extent, is just out of favor. And so I'm spending a lot of time looking at stuff in sort of that 3 to 8 million AR range that really is in a position to leverage AI because they've got great data assets. The thing that's changed for me now is I'm also looking at on the operational side. Are they really ready to adopt this and what they're doing on their go-to-market and grow from there? So I'm really excited about that. And again, you want to talk about storytelling with family offices. I go in and talk about this and I talk about how it's different, right? So I have to explain why SaaS is interesting. But then I also get really animated because I give them operational stories. I go, let me tell you how I used to do things, right? Let me tell you what things used to look like when I built a go-to-market function around humans. Now let me take you through the 3 stages here. Stage 1 is human. Stage 2 is Iron Man. I use Iron Man because it's a human enabled with powerful technology. Yeah. And step 3 is the Matrix, the good Matrix, but it's the Matrix, right? How do you kind of run it that way, right? But I kind of walk them through it and I give them very tangible examples and they really understand it. So the thing that's changed for me is before I'm a product person. I was really betting on what AI is doing on the product side. I'm now really focused on looking at opportunities where we can operationalize it really quickly as well. So I think there's a lot of opportunities there. I personally don't invest in seed stage of stuff right now because I think that market is overheated. And a lot of stuff in the AI world I'm around is overheated as well. So I try to find things that don't go talk about AI first, that talk about SaaS first. And within that, I try to look for ones that are saying, well, I know we're SaaS, but we talk to you about the work that we're really doing to bring AI to our product offerings. So that's where we are. Multiples are outstanding right now. I think this vintage is going to be really good for anyone who gets into it. And hopefully your listeners are successful in raising their own funds so they go out there and take advantage of it. Because I do think we're in an interesting window for the next 2 or 3 years. And as much as people talk about AI, I would encourage people to look at just plain old SaaS as well.
Brilliant. Yeah. And they will be successful. So we have a community called fundraisecapital.co where we teach people how to do it. Our first year, they raised $1 billion. So I don't know. I was pretty happy. Felt like a proud papa. I feel like we taught some excellence in the capital raising industry. But even if no matter what, there's still more to learn. And you are certainly teaching me a lot today, my man. So this is brilliant. Before we wrap things up and just as we round third base, I'm wondering if you could leave behind, say, 2 or 3 deep competitive advantages that people can just really think about, possibly implement, just really bring this home for people from all of your experience. What would you say?
Yeah. So first of all, I think family offices are a great investor base. I really do. And, my intention would be to continue to build us out along those routes. Doesn't mean I won't eventually potentially bring institutions in, but I really enjoy working with family offices. So I think that for funds, you got to decide you want to make a commitment to that, because I do think it's a path. And I don't think you should think about it as a fill-in to an institutional round. I think if you want to go family office, go family office. For them, family offices, keep in mind, they're great for emerging managers. We talked about that. While performance is important, if you're a new manager, they really care about the stories and other experience as well. They're not going to necessarily ding you because you don't necessarily have good results yet, or the way institutions might. Again, they're business builders. They're looking at it. You're building your firm. They're going to be excited about hearing your stories. They're not professional investors. They understand that you're an entrepreneur trying to do a thing in your space. They're going to be very excited about engaging with portfolio companies. So going all in on family offices, I think is a really good way to go for people that are ready to make that commitment. But as we talked about, they take a different approach. You need to be ready to do skin in the game. And again, there's different forms of skin in the game, but in the end, it's going to come down to money. And, again, when I was raising this thing, I talked about percent of net worth, and let them know, like, I'm really into this. So they're going to care about that. So you got to be ready for that. You won't have that as much with institutions. You need to make sure you can match your strategy to their mission in some way. You need to make sure that the things that you are doing are meaningful to them and meaningful to the things they support. And it's not just on a global basis. You have to do it office by office. And the deeper research that you have to do up front and the relationship building is required. It takes a lot of time. So you have to be ready for all that. So they're great to start with. Families are great, but they definitely require a different approach. And then the last thing I'll just say is they do have really unexpected benefits that I'm still uncovering. One of them is, again, they become great customers for your portcos if you get the right ones on board. They can also be industry advocates. They can help you get into other opportunities with your companies. They're really good at that. They have their own network of private deals. At least one of my deals, one deal was 100% sourced by one of my family offices. Others have been influenced or indirectly sent to us. So they're a great source for proprietary deals. In essence, we're all looking for proprietary sources. If you have an investor base that owns the deals, there's your proprietary source. And they love to share the networks. They like to get out there and help you. Some ways I feel like I'm being paraded a lot of times around in front of folks, but they do love to share their networks and have them engaged. So they have a lot of benefits. So again, they're a great base. You got to commit to them. You got to be ready for the different challenges they provide. But there's a lot of great benefits you can get out of them. A lot of fun. I mean, it's enjoyable to sit down with people and hear the stories about the businesses they're building or have built and relate to them. And, I would say now, to a great extent, I've added 20 plus mentors to my list of folks that I call on all the time for advice.
I love that. That's mentor's code for a really smart friend that won't let you get away with any nonsense. So at least that's bullshit. What I call it.
That's for sure. Yeah, no, they call you on it all the time, which is great.
As they should. If you're trying to grow and you ask them to join their journey, it's like they're okay. Don't waste my time. You're either going to do it or you're not. So right. I love it, and that's a great mentor as well. So before we wrap things up, any final thoughts? Any ways people can reach out to you if they want to learn more? Anything at all?
Yeah. So jim@buildgroup.com. I'm happy to chat with folks. I run our IT, so if you just send it to dog@buildgroup.com, it comes to me too. I get the catch-alls. So you don't have to get that perfectly right. But I love talking about this. I actually have spent, not at the scale you have, Ryan, but I have helped some emerging fund managers think through this. One of the things I'm always pleased to do is for investors that are interested in meeting with our investors, funds that want to meet our investors, I'm always happy to do intros. Always tell people, you got to explain to me what you do, how it's differentiated, and I'll try to figure out the right person, but I'm always happy to help with that as well. And again, this is one of the benefit family offices expect that, right? And the first thing they're going to ask me is, Jim, would you invest in this fund? So be ready, because I got to always answer that question. Again, talking about skin in the game. But yeah, no, reach out to me at jim@buildgroup.com. I'm here in Austin, beautiful Austin, Texas, a little bit hotter than Edmonton. But if anyone's ever here in town and they want to meet, I'm more than happy to chat with them.
That's incredible, man. So just to summarize everything that Jim and I spoke about, prioritize raises based on checks from a network, not just checks from the one person. Second one is be ready to work closely with the family. They want to hear from you, and that is awesome. The other thing you mentioned was be sure you're well aligned throughout the relationship, not just at the beginning of the deal. So that is a fallacy a lot of new managers have. Then, just raising capital, it is challenging at times. That's challenging for those who don't know what they're doing, for sure. But family offices are looking for deals from emerging managers and deal syndicators. So don't forget, they don't always have access to the deal level that you might think. And so they might be praying to God to meet you right now. Family offices, they're great for emerging managers. Be ready for their unique approach and just appreciate that some may end up becoming a customer and heck, even a friend. You do these things and you too will be well on your way in your pursuit of making billions.